Earnings season is approaching, and I can already feel the anxiety building across Wall Street. In a few short weeks, thousands of companies will report their quarterly results. Stock prices will swing wildly. Analysts will scramble to update their models. Financial television will turn into a circus of predictions and hot takes. And most investors will make the same mistakes they always make. They will buy based on headlines. They will sell based on fear. They will chase whatever stock moved the most in either direction, convinced that short-term price movements tell them something meaningful about long-term value. I have watched this pattern repeat itself for over 70 years. Every quarter, the same drama unfolds, and every quarter, the vast majority of investors end up worse off than if they had simply done nothing at all. But here is what most people do not understand about earnings season. It is not a time to react. It is a time to prepare. And the investors who consistently build wealth are not the ones who make the best trades after earnings are announced. They are the ones who position themselves correctly before the announcements ever happened. They own businesses so strong, so well positioned, so fundamentally sound that quarterly earnings reports are almost irrelevant to their long-term thesis. Today, I am going to share with you the only 3 stocks I would buy before the next earnings season, not because I think they will beat earnings estimates, not because I think their stock prices will jump 20% overnight. I am sharing these 3 stocks because they represent businesses that will be more valuable 5 years from now, 10 years from now, regardless of what happens in any single quarter. This is a completely different way of thinking about investing. And if you can truly internalize this approach, you will never again feel anxiety about earnings season. You will never again make panic decisions based on short-term results. You will simply own great businesses and let time do the heavy lifting. Let me start by telling you why most investors get earnings season completely wrong. They treat it like a casino. They place bets on whether a company will beat or miss expectations as if that single data point tells them everything they need to know about a business. They watch the stock price move after hours and feel either euphoric or devastated based on which direction it went. But here's the thing about earnings. They measure what happened in the past 3 months, just 3 months. And those 3 months often include all sorts of noise that has nothing to do with the long-term trajectory of the business. Maybe the company accelerated some revenue into the quarter to meet analyst expectations. Maybe they delayed a marketing campaign and saved some expenses. Maybe currency fluctuations helped or hurt their international sales. None of these things tell you whether the business will be more valuable in 5 years. I have owned Coca-Cola since 1988. That is over 35 years in that time. The company has reported more than 140 quarterly earnings reports. Some were good, some were disappointing, some caused the stock to jump, some caused it to fall. And you know what? None of it mattered. The only thing that mattered was that Coca-Cola continued to strengthen its brand, expand its distribution, and generate enormous amounts of cash that it returned to shareholders. That is what builds wealth over decades, not beating analyst estimates by 3 cents per S-hair. So when I think about what stocks to buy before earnings season, I am not thinking about which companies will report the best numbers. I am thinking about which businesses have such powerful competitive advantages, such strong market positions, such inevitable paths to growth that their quarterly results are almost irrelevant to the long-term story. These are the businesses I want to own. And today, I am going to share 3 of them with you. The first stock I would buy before earnings season is Apple. Now, I know what some of you are thinking. Apple is one of the most followed, most analyzed, most scrutinized stocks in the entire market. Every analyst on Wall Street has an opinion on iPhone sales. Every financial journalist is writing about whether Apple will beat or miss expectations. How can this possibly be a safe stock to own going into earnings? And that reaction tells me exactly why most investors fail. They focus on the wrong things. They focus on quarterly iPhone units instead of the underlying business economics. They focus on short-term revenue growth instead of the massive moat Apple has built around its ecosystem. Let me explain why Apple is one of the safest stocks to own through any earnings season, regardless of whether the quarterly numbers come in above or below expectations. Apple has over 1.5 billion active devices in the world. Think about that number for a moment. 1.5 billion iPhones, iPads, Macs, Apple Watches, and other devices are being used right now by people who have chosen to be part of the Apple ecosystem. These are not casual users. These are people who have integrated Apple products into their daily lives. They wake up and check their iPhone. They track their fitness with their Apple Watch. They work on their MacBook. They store their photos in iCloud. They buy apps from the App Store. They pay for things with Apple Pay. Once someone is inside this ecosystem, they almost never leave. The switching costs are enormous, not just financial switching costs, although those exist too. The real switching costs are the time and effort required to learn a new system, to transfer all your data, to give up the seamless integration between devices that Apple provides. Most people simply will not do it, even if a competitor offers a phone that is slightly better in some technical specification. Apple users stay with Apple. This is what I call a wide moat, a competitive advantage so powerful that it protects the business from competition for decades. And Apple's moat is getting wider, not narrower. Every year, Apple adds new services that make the ecosystem stickier. Apple Music, Apple Television Plus, Apple Fitness, Apple Arcade, Apple News, Apple One bundles that combine multiple services at a discount. Each of these services gives users another reason to stay in the ecosystem. Each one generates recurring revenue that Apple collects month after month, year after year, regardless of whether someone buys a new iPhone this quarter or waits until next year. The services business is now generating over $100 billion in annual revenue. $100 billion. That is bigger than most Fortune 500 companies, and it is growing at double-digit rates with gross margins above 70%. This is one of the most profitable business segments I have ever seen. So when analysts obsess over quarterly iPhone shipments, they are missing the bigger picture. Yes, iPhone sales matter. The iPhone is still the anchor of the ecosystem, but the real value of Apple is the recurring revenue stream from services that flows from having 1.5 billion loyal customers locked into the platform. Let me give you a specific example of why quarterly earnings do not matter for Apple's long-term value. In fiscal 2023, Apple reported that iPhone revenue declined year over year. The stock dropped. Analysts wrote negative reports. Headlines proclaimed that Apple's best days were behind it. And what happened next? The stock recovered and went on to new all-time highs because intelligent investors understood that 1 quarter of iPhone decline meant nothing to the long-term thesis. What mattered was that services revenue kept growing. What mattered was that Apple kept buying back massive amounts of stock, increasing the ownership stake of remaining shareholders. What mattered was that Apple continued to generate over $100 billion in free cash flow annually, allowing it to invest in new products, return capital to shareholders, and strengthen its competitive position. This is why I own more Apple stock than any other single position in my portfolio. Not because I think Apple will beat earnings estimates this quarter. I have no idea whether they will or not. And frankly, I do not care. I own Apple because I believe the business will be significantly more valuable 10 years from now than it is today. And that belief is not dependent on any single quarterly report. When you own a business like Apple, earnings season becomes a non-event. You might see the stock price move 5% in either direction after the report. But, that 5% move is just noise. The underlying value of the business is not changed by 5% in a single day. Only the market's perception has changed. And market perception always eventually aligns with business reality. The second stock I would buy before earnings season is Visa. This is a business that most people fundamentally misunderstand. They think Visa is a credit card company. They think Visa makes money by lending money and charging interest. They worry about credit defaults and consumer debt levels. And because they misunderstand the business, they make bad investment decisions. Visa is not a credit card company. Visa is a toll booth on the global economy every time someone swipes a Visa card anywhere in the world. Visa collects a small fee. They do not lend money. They do not take credit risk. They simply facilitate the transaction and collect their toll. It is one of the most beautiful business models I have ever encountered. Think about what Visa has built. They have created a network that connects hundreds of millions of merchants with over 4 billion cards issued worldwide. This network processes over $15 trillion in payment volume annually. And for every transaction that flows through their network, Visa collects a small percentage. Now here's where it gets really interesting. As the economy grows, as more transactions shift from cash to electronic payments, as emerging markets develop and their citizens start using cards instead of cash, the volume flowing through Visa's network grows, and Visa's costs do not grow proportionally. Processing and additional transaction costs Visa almost nothing. The infrastructure is already built. The network is already in place. This is called operating leverage, and Visa has it in spades. As revenue grows, profits grow even faster because the marginal cost of additional volume is essentially zero. This is why Visa consistently generates operating margins above 60%. 60%. That is extraordinary. Most businesses would consider 30% operating margins to be excellent. Visa operates at double that level. So what happens during earnings season for Visa? The company reports another quarter of steady growth. Payment volumes increased, revenue grew at a healthy rate. Profits grew even faster, and the stock might move a few percent in either direction based on whether the numbers came in slightly above or below analyst expectations. But here's what really matters. The secular shift from cash to electronic payments is not going to reverse. If anything, it is accelerating. The pandemic pushed even more transactions online and conditioned people to use contactless payments. That behavior is not going back to the old ways. Cash is dying. And every dollar that shifts from cash to electronic payments is a dollar that flows through Visa's network. I've studied this business extensively. I have looked at the competitive dynamics. I have analyzed what it would take for a competitor to disrupt Visa's position. And I have concluded that it is almost impossible. To compete with Visa, you would need to build a network that connects merchants and cardholders globally. You would need to convince millions of merchants to accept your new payment method. You would need to convince billions of consumers to carry your card and use it instead of their existing Visa card. You would need to invest tens of billions of dollars in infrastructure, security, and fraud prevention. And you would need to do all of this while Visa continues to invest in their own network, continues to add new features, continues to strengthen their relationships with banks and merchants. No one is going to do this. The barrier to entry is simply too high. Apple Pay and Google Pay sound like competitors, but they actually run on top of the Visa network. When you tap your phone to pay for something, Visa still collects their fee. These digital wallets are complementary to Visa, not competitive. Even cryptocurrency, which some people thought would disrupt traditional payment networks, has failed to gain traction for everyday transactions. Bitcoin is too volatile. Transaction speeds are too slow. User experience is too complicated. And regulatory uncertainty makes merchants reluctant to accept it. Meanwhile, Visa keeps processing $15 trillion in volume annually and collecting their toll on every transaction. This is the kind of business you want to own before earnings season. A business with such a dominant market position, such powerful network effects, such high barriers to entry that quarterly results are almost guaranteed to be good. Not spectacular every quarter, not record-breaking every quarter, just consistently good quarter after quarter, year after year, decade after decade. The third stock I would buy before earnings season is Microsoft. And I want to tell you something that might surprise you about why I find this business so compelling right now. For most of my career, I avoided technology stocks. I famously missed the opportunity to invest in Microsoft when Bill Gates and I became friends decades ago. I watched the company grow from a small software company to one of the most valuable enterprises in the world. And I did not participate in that growth. It was one of my biggest mistakes as an investor. But what Microsoft has become today is very different from the Microsoft of 30 years ago, and I believe it is positioned to benefit from one of the most significant technology shifts in modern history. Let me explain what I see in Microsoft today. The company operates in three main segments, all of which have durable competitive advantages. First, there is the productivity software business. Microsoft Office is used by virtually every business in the developed world. Word, Excel, PowerPoint, Outlook. These products are so deeply embedded in how companies operate that switching to alternatives would require retraining millions of employees, converting years of documents, and disrupting established workflows. Companies are not going to do this. They will keep paying Microsoft for Office licenses indefinitely. And Microsoft has successfully transitioned this business to a subscription model through Microsoft 365. Instead of buying software once and using it for years, companies now pay monthly or annual fees for access. This creates predictable, recurring revenue that is much more valuable than one-time purchases, and Microsoft keeps adding features, integrating artificial intelligence capabilities and making the subscription more valuable over time. Second, there is the gaming business, which most serious investors overlook. Microsoft owns Xbox, one of the three major gaming platforms. More importantly, Microsoft owns Xbox Game Pass, a subscription service that gives users access to hundreds of games for a monthly fee. This is the Netflix model applied to gaming. And with the acquisition of Activision Blizzard, Microsoft now owns some of the most valuable gaming franchises in the world, including Call of Duty, World of Warcraft, and Candy Crush. Gaming is one of the largest entertainment industries in the world, bigger than movies and music combined. And Microsoft is positioned to capture a significant share of this market through both hardware and subscription services. But the real reason I am so excited about Microsoft is the third segment. Azure, their cloud computing platform. This is where artificial intelligence is transforming the entire technology landscape, and Microsoft has positioned itself to be the biggest beneficiary of this transformation. Let me explain what is happening. Artificial intelligence requires enormous amounts of computing power, training large language models, running inference at scale, processing the data that feeds these systems. All of this requires infrastructure that most companies do not have and cannot afford to build themselves. So they turn to cloud computing providers like Azure to rent the computing power they need. Microsoft has partnered with OpenAI, the company behind ChatGPT. This partnership gives Microsoft exclusive rights to commercialize OpenAI's technology. And Microsoft has integrated AI capabilities throughout its product suite. Copilot in Office helps users write documents, create presentations, and analyze data. Copilot in Windows helps users navigate their computers more efficiently. Copilot in Azure helps developers write code and manage infrastructure. This is not a small incremental improvement to Microsoft's products. This is a fundamental transformation of how people interact with computers, and Microsoft is at the center of it. Every major company in the world is now trying to figure out how to use artificial intelligence to improve their operations, serve customers better, and stay competitive. And a huge number of those companies are going to build their AI capabilities on Microsoft Azure using Microsoft's tools, paying Microsoft monthly fees for the privilege. The capital expenditure required to build AI infrastructure is staggering. Microsoft is investing tens of billions of dollars in data centers, specialized chips, and cooling systems to meet the demand. But here's the thing about these investments. They create barriers to entry. Competitors who want to challenge Microsoft in cloud computing need to make similar investments. And there are only a handful of companies in the world with the financial resources and technical expertise to compete at this level. Google has the resources and expertise. Amazon has the resources and expertise. A few others might emerge. But this is not a market where startups can disrupt incumbents with clever ideas and small investments. This is a market where scale, infrastructure, and existing customer relationships matter enormously. and Microsoft has all three. So what happens during earnings season for Microsoft? The company reports another quarter of solid growth across all three segments. Azure revenue grows at 30% or more. Office revenue grows at a more modest but still healthy rate. Gaming revenue fluctuates based on game release schedules but trends upward over time. And the stock might move a few percent based on whether these numbers came in above or below expectations. But the long-term trajectory is clear. The shift to cloud computing is irreversible. The adoption of artificial intelligence is accelerating, and Microsoft is positioned to benefit from both of these secular trends for the next decade and beyond. This is what I mean by buying stocks before earnings season that do not depend on quarterly results. I do not know whether Microsoft will beat analyst estimates this quarter. Maybe they will report slightly lower Azure growth due to economic uncertainty. Maybe currency fluctuations will impact their international revenue. Maybe some large customer will delay a contract signing until the next quarter. None of these things change the fundamental thesis. What matters is that Microsoft is one of only a few companies in the world positioned to capitalize on the AI revolution. What matters is that their competitive position is actually strengthening over time as they invest in infrastructure and integrate AI throughout their products. What matters is that they generate over $100 billion in free cash flow annually, giving them the resources to invest in growth while returning capital to shareholders. Now let me step back and explain what these three stocks have in common, because the specific names matter less than the principles behind choosing them. All three of these businesses have what I call durable competitive advantages, not temporary advantages that competitors can replicate, not advantages that depend on having the lowest cost or the best product features at this moment in time. These are structural advantages built into the nature of the businesses themselves. Apple has an ecosystem advantage. Once customers are inside, they stay inside. The value of being an Apple user actually increases as you add more devices and services. This creates a virtuous cycle where the business gets stronger over time. Visa has a network advantage. Every merchant who accepts Visa makes the card more valuable to cardholders. Every cardholder who uses Visa makes accepting Visa more valuable to merchants. This two-sided network effect is extremely difficult for competitors to replicate. Microsoft has an infrastructure advantage. The billions of dollars they have invested in data centers, the partnerships they have established with enterprises, the talent they have accumulated. All of this creates barriers that protect their position even as technology evolves. All three of these businesses generate enormous amounts of free cash flow. This is crucial because free cash flow gives management options. They can invest in new growth opportunities. They can acquire complementary businesses. They can return capital to shareholders through dividends and buybacks. They can weather economic downturns without cutting the investments that drive long-term value. All three of these businesses benefit from secular trends that are not going to reverse. The digitization of commerce, the shift from cash to electronic payments, the migration of computing to the cloud, the adoption of artificial intelligence. These are not temporary fads. These are fundamental changes in how the economy operates. And all three of these businesses have management teams with track records of intelligent capital allocation. Tim Cook at Apple has returned hundreds of billions of dollars to shareholders while investing in new product categories. Alfred Kelly and now Ryan McInerney at Visa have consistently expanded the network while maintaining extraordinary profitability. Satya Nadella at Microsoft has transformed the company from a declining PC software business into a cloud computing giant. This is what you should be looking for when you invest before earnings season, not stocks that you think will beat estimates, not stocks that are likely to jump 10% on good news. Look for businesses with durable competitive advantages, strong free cash flow generation, exposure to secular growth trends, and proven management teams. When you own these kinds of businesses, earnings season becomes irrelevant. You might see short-term volatility. You might see the stock drop 5 or 10% on a disappointing quarter. but you know that the long-term value of the business has not changed based on 3 months of results, and you have the confidence to hold through the volatility or even add to your position at lower prices. Let me tell you a story that illustrates this point. In the early 2000s, after the dot-com bubble burst, technology stocks were devastated. Microsoft fell from around $60 per S-share to under $20. The company was being sued by the government for antitrust violations. The PC market was maturing. The stock went sideways for over a decade. Most investors gave up on Microsoft. They sold their shares and moved on to whatever was hot at the moment. But the investors who understood the business, who recognized the durable competitive advantages, who could look past the short-term noise they held on, or better yet, they added to their positions when the stock was cheap. And those investors were eventually rewarded beyond their wildest expectations under Satya Nadella's leadership. Microsoft transformed itself. Azure became one of the dominant cloud platforms. Office transitioned to a subscription model. The company embraced AI and positioned itself at the center of the transformation. Today, Microsoft is worth over $3 trillion. Those patient investors who held through the difficult years, who did not panic during disappointing earnings seasons, who understood that the business value would eventually be recognized. They made 10 times their money or more. This is how wealth is built. Not by trading around earnings announcements, not by trying to guess which companies will beat or miss expectations, by owning great businesses and holding them through all the noise and volatility that the market throws at you. I want to leave you with one final thought about earnings season. The anxiety that most investors feel about earnings reports comes from not truly understanding what they own. If you are nervous about how your stocks will react to quarterly results, it probably means you do not have conviction in the underlying businesses. And if you do not have conviction, you should ask yourself whether you should own those stocks at all. When I own Apple, I do not worry about iPhone sales in any particular quarter. I understand the ecosystem. I understand the recurring revenue from services. I understand the massive cash flow generation and the capital return program. One quarter of results does not change my thesis. When I own Visa, I do not worry about whether consumer spending was strong or weak in any particular quarter. I understand that the long-term shift from cash to electronic payments is unstoppable. I understand that Visa's network effects make the business almost impossible to disrupt. One quarter does not change my thesis. When I own Microsoft, I do not worry about whether Azure growth came in at 30% or 28%. I understand that the shift to cloud computing is a decade-long transformation. I understand that AI adoption is just beginning. I understand that Microsoft is positioning itself to benefit from both trends. One quarter does not change my thesis. This is the mindset you need to adopt. Stop thinking of yourself as someone who buys and sells stocks. Start thinking of yourself as someone who owns businesses. Real businesses with real products, real customers, real competitive advantages, and real cash flows. When you make this mental shift, earnings season stops being a source of anxiety and starts being an opportunity to assess whether your businesses are executing on their long-term strategies, an opportunity to add to positions that might temporarily decline on disappointing results, an opportunity to stay patient while everyone else panics. The three stocks I have shared with you today, Apple, Visa, and Microsoft, are not recommendations to trade. They are examples of what it looks like to own businesses built to succeed over decades. They are businesses I would be comfortable owning through any earnings season, through any economic environment, through any market condition. Because in the end, investing is not about predicting what will happen next quarter. It is about identifying businesses that will be more valuable over time and having the discipline to hold them while that value compounds. That is the only reliable path to building wealth in the stock market. Everything else is just noise. Now I want to address something that I know many of you are thinking. What about valuation? These three stocks are not cheap by traditional metrics. Apple trades at over 30 times earnings. Visa trades at a premium to the market. Microsoft is one of the most expensive large cap stocks in the world. How can I recommend buying them before earnings season when they are so richly valued? This is a legitimate concern, and I want to address it directly. Valuation matters. I have spent my entire career preaching the importance of buying businesses at prices below their intrinsic value. I have passed on countless opportunities because the price was too high relative to the value I could calculate. But here is what I have learned over 7 decades of investing. Some businesses deserve premium valuations because they are genuinely premium businesses. The question is not whether a stock trades at a high multiple. The question is whether the business quality justifies that multiple and whether the business can grow into the valuation over time. Let me give you an example with Apple. When I first started buying Apple stock around 2016, people told me I was crazy. Apple was already one of the largest companies in the world. The stock traded at a premium to the market. iPhone growth was slowing. How could this possibly be a good investment? But I saw something different. I saw a business with over 1 billion loyal customers. I saw a services segment growing at double-digit rates. I saw management buying back massive amounts of stock every quarter, increasing my ownership stake without me having to do anything. I saw a company generating so much cash that it literally could not spend it all even while investing heavily in new products and returning billions to shareholders. Today, that investment has more than quadrupled, not because I bought at a cheap price. I did not. I bought at what most people would consider an expensive price, but the business quality was so high, the competitive position so strong, the growth opportunities so significant, the business grew into the valuation and beyond. This is the key insight that separates great investors from average ones. Average investors focus on finding cheap stocks. Great investors focus on finding great businesses at reasonable prices, and sometimes a reasonable price for an extraordinary business looks expensive compared to ordinary businesses. Think about it this way. Would you rather buy an average business at 10 times earnings or an extraordinary business at 30 times earnings? The average business might struggle to grow. It might face competitive pressures. It might require constant reinvestment just to maintain its position. Over 10 years, that cheap stock might barely appreciate at all. The extraordinary business compounds at high rates. Its competitive advantages strengthen over time. Its earnings grow year after year, over 10 years. That expensive stock might triple or quadruple in value, even though you paid a premium at the outset. I am not saying you should ignore valuation entirely. Price always matters. But you should think about valuation in the context of business quality, competitive position, and growth potential. A stock that looks expensive today might actually be cheap when you consider where the business will be in 5 or 10 years. All 3 of the stocks I mentioned today fit this description. They are not cheap by traditional metrics, but they are businesses of such exceptional quality that I believe they will grow into their current valuations and beyond over the next decade. Let me also talk about something else that concerns many investors during earnings season, the fear of missing out on a big move. I see people make this mistake constantly. They think that if they do not own a stock before earnings, they will miss the big jump. If the company reports good results, here is the truth. Trying to capture short-term earnings moves is gambling. Not investing, yes, sometimes stocks jump 20% on earnings, but they also sometimes fall 20% on earnings, and predicting which will happen is essentially impossible. I have read thousands of earnings reports over my career. I have studied companies more deeply than almost anyone else on the planet, and I still cannot consistently predict how stocks will react to earnings. The market is incredibly efficient at pricing and expectations. Any information you have is likely already reflected in the stock price. And the surprise, by definition, is unpredictable. So instead of trying to capture short-term moves, focus on positioning yourself to benefit from long-term value creation. Own businesses that will be worth more over time, regardless of short-term fluctuations. This is a much more reliable path to building wealth. And here is the beautiful thing about this approach. When you own great businesses for the long term, you do not need to be right about every quarter. You can be wrong about short-term results and still make money over time. In fact, when a great business reports disappointing results and the stock drops, that is often an opportunity to buy more at a better price. I have done this countless times throughout my career. A company I own reports numbers that disappoint Wall Street. The stock drops 10 or 15%. Analysts downgrade it. Headlines proclaim that the company is in trouble. And I quietly add to my position because I know that one quarter does not change the long-term value of the business. This requires conviction. It requires truly understanding what you own. It requires being able to distinguish between a temporary setback and a permanent impairment. But when you can do this, earnings season becomes a source of opportunity rather than a source of anxiety. Let me give you one more piece of advice about navigating earnings season. Do not watch the stock price minute by minute. Do not sit glued to your computer screen waiting for the results to come out. Do not read every analyst report and every financial news article about how to interpret the numbers. All of this activity creates the illusion that you are doing something productive, but it is actually counterproductive. It increases your anxiety. It tempts you to make impulsive decisions. It distracts you from the only thing that really matters, which is whether the underlying business is executing on its long-term strategy. Here is what I do during earnings season. I read the quarterly report when it comes out. I look at the key metrics that matter for the business. I assess whether the company is on track with its long-term plans, and then I move on with my life. I do not agonize over whether the stock went up or down. I do not second-guess my investment decision based on one quarter of results. I just keep owning the business and let time do its work. This is the discipline that separates successful investors from unsuccessful ones. The ability to stay calm when everyone else is panicking. The ability to think in years and decades when everyone else is thinking in days and weeks. The ability to ignore the noise and focus on what really matters. The three stocks I have shared with you today, Apple, Visa, and Microsoft, are businesses built to succeed over the long term. They have competitive advantages that protect them from disruption. They generate cash flows that allow them to invest in growth and return capital to shareholders. They benefit from secular trends that are not going to reverse own these businesses. Hold them through earnings season after earnings season. Do not panic when short-term results disappoint. Do not sell just because the stock price drops temporarily. Trust in the quality of the business and let compounding work its magic. This is how I have built wealth over 7 decades. This is how I have navigated countless market cycles, countless earnings seasons, countless periods of fear and uncertainty. By owning great businesses and holding them for the long term, and if you can adopt this mindset, if you can truly internalize this approach to investing, you will find that earnings season is no longer something to fear. It is simply another quarter in the life of a business you own, another data point in a multi-decade journey of value creation. That is the perspective I want you to have. That is the mindset that will serve you well, not just this earnings season, but for the rest of your investing life. Own quality, think long-term, ignore the noise. The rest takes care of itself.